The American stock markets are on an all-time high again. The tech sector is showing great business results and the lagging value shares are once again catching up. What's up everyone, my name is Joris. Welcome back to my channel. In the previous months we have seen one of the biggest and fastest crashes of the stock market in the recent decades. In March, the stock market dove over 30% in just a mere few weeks, with drops of over 10% per day. As tragic and quick as that was, the recovery time was just as swift. Now, 8 months later, the leading stock indexes are reaching new all-time highs. Is this the year-end rally? What will the next month bring, and how should we invest right now? Will Santa bring us nice returns, or will we get coal in our stockings? First of all, let's look at the last few months. Ever since the bottom of the market in March, the stock went up considerably, limiting the global losses. In June, most major indexes limited their year-to-date negative returns to -5%. From June up to November really, we saw next to no movement at all in the markets. The company reports in June and October were overall better than feared, which supported the markets. But on the other hand, the exponential curve of the global illness cases and the major uncertainty about the American presidency elections put downward pressure on the markets. November, the first vaccine news boosted the markets by 4% in just 15 minutes. The weeks after, more and more companies were releasing press issues about possible vaccinations, which tells us that finally there is an end dawning on the horizon. Markets are euphoric, but maybe a bit too much too soon. Don't get me wrong, it is good news that there is a vaccination, but that does not mean that we will get it by tomorrow and that the world will open later this week. It might take weeks or even months until vaccinations are officially approved by the health regulations, and the production will have to keep up with the demand. If everything goes right and smoothly, in March, I expect that major vaccination rounds will occur. Until then though, governments might still consider keeping the current lockdown rules as strict as they are now. The economy is not yet open completely, so we should not really count on that. Apart from that, we also have a new president in the United States. Biden will officially take his place in the White House at the end of January 2021. The weeks before the elections, volatility was through the roof. The VIX index didn't want to go down at all. It remained high. Investors had no idea where the market would be going and everyone was very nervous. Biden is a Democratic president, and as long as the Senate remains Republican, investors have great hopes for stock returns. History shows us that divided power, whereas the president is a Democrat and the Senate is a Republican, or vice versa, have a more positive return on the markets. And that's why the markets went up quite a lot recently. Biden is a Democrat president, the House is also Democratic, but the Senate will probably be Republican. The major topics of frustration and uncertainty, the American elections and the global illness. But now, at last, at the start of November, both big causes of global nervousness has gotten major positive news. Volatility dropped, stock markets went up, and they kept going. Up until a point that a lot of worldwide indexes got a positive year-to-date return. For now. It is all over the financial news sites. December effect already. Has the year-end rally already started? The Santa Claus rally is going. Time for the January effect. But what does all of this mean? The December effect, or Santa Claus rally, is used to describe the occurrence of better than average returns during the last few trading days of the year. The theory was first published by Yale Hirsch, a stock market analyst and author of the annually published book called The Stock Trader's Almanac. He found that during the days between Christmas and New Year's, the trade volume of the stock market is very low. Very few people are actually trading during these days, only those who really have to. The people who are buying are mostly optimistic for the new year, but that's basically a mindset. If you would look at the SPY index, started in 1993, the Santa Claus rally has proven to have a positive outcome in 17 out of 26 years, or about 65% of the cases. Another study of HEFFX Australia shows us data from 1950 until 2019. 75% of Decembers have had positive end returns, with an average net return at the end of the month of 1.3%. This is not a coincidence. A study of Real Investment Advice shows us that the data of average returns in December from 1919 to 2017. They found that the average return in December is 1.7%, while all the other months only averaged a positive of 0.62%. Next, they looked at which trading days have the biggest impact on those positive returns. Turns out that the sweet spot is located between the 10th and the 17th trading day of December. They then divided December up into 3 parts: trading days 1 through 9, 10 through 17, and then from the 18th to the end of the month. The start of December is neutral, with as much positive days as negative ones. Trading days 10 to 17 proved to have an average daily return of 0.2%, and the last few trading days often show more negative days than positive ones, with a slight negative return. So, is the December effect or Santa Claus rally a real thing? Well, apparently it is. And that's just a trick. If a lot of people think that something will occur, they will prepare for it, and inevitably it will occur. And thus, a rally will not be the cause of positive investors, but a result of them. A self-fulfilling prophecy, or a vicious cycle, who knows. The optimism of the investors and the hope that this year there will be another year-end rally creates a snowball effect. Pardon my Christmas pun. People buy because the markets rise, and the markets rise because the people buy, and so on. But do beware, we are talking about statistics here. It is not because something is likely to be happening that it will actually be happening. If an event occurs in 65% of cases, that means that it won't occur in 35% of cases, or in other words, 1 in 3 chances it won't happen. So trying to ride the New Year's rally is like timing the market. It is next to impossible in the long term. We are now at the end of November, so technically there are still 15 trading days away from the sweet spot. Proclaiming we are in the year's end rally already is ridiculous, because the theory only affects the last few trading days of the year. We might be in an uptrend, but we cannot know what the markets will bring tomorrow. You should never try to time the market. The best you can do is just to stay invested and let your profits run. An end of the year rally is great, but if you're invested, it goes up automatically. It might seem that all the lights are go now, but there will always be a reason why you should invest or should not invest at a certain time. Pick a certain date and invest every month on said date. I have clients that are sitting on cash since the start of 2018. They thought the markets then were too expensive. They went cash, and they thought a crash was imminent. Since they have missed out on 30% of market returns, and that even includes the crash of 2020. Now they don't want to invest the money because the markets are again too expensive. Do yourself a favor and take the luck out of the equation. Invest consistently and in the long run. Don't look at the stock market every day, and limit your exposure to the news. This way you will be way better off than you were to time the markets. And you'll have a lot less stress too. If you want to know how to invest consistently and how to build up your portfolio, I have made some videos about that already. I will put a link to them down in the description below. Feel free to check them out. And if you have a lump sum to invest, you might consider investing it all in one go. Watch my video here, where I explain this better. If you've enjoyed this video, be sure to leave a like for the YouTube algorithm. And don't forget to subscribe and hit the notification bell to be alerted when a new video comes out. If you want to learn more about personal finances and you want to keep watching my videos, then you can learn more by clicking one of these videos on the side. I thank you for watching, and I will see you in the next one.